Ari Wulfsohn, welcome to Beyond the Board. It's great having you here this morning.
Delighted to be here, Ella. Thank you very much for inviting me, discussing Africa. So I enjoy this opportunity. Thank you.
Right. So let's get into it. I'd love you to introduce yourself in your own words. So paint the original story for us, childhood, first exposure to business or markets, and a thread that connects those early years to the work that you do now.
Thank you. I won't bore everyone with all my early childhood, but to keep it reasonably succinct, we are a 3-generation African family. My grandfather was a Russian immigrant in the 90s, arrived in Zambia and Zimbabwe, actually a place called Livingston by the Victoria Falls. In the 1930s, started cattle trading. My father was born in Zambia. I was born in Zambia. My mother was born in Zimbabwe. My parents met at Cape Town University. And over the years, between my grandfather, my father, then myself, we built out quite a large private conglomerate across East and Central Africa. The original business was cattle farming. We had about pretty large cattle farms in Zambia, about 40,000 head of cattle. And then we diversified into butcheries, other agricultural products, retail, timber, paper, manufacturing, financial services, and really built out a very diversified private conglomerate across East and Central Africa for many, many decades. Bizarrely, back in the 90s, maybe people don't remember this, but Harare, Zimbabwe was a booming country. It was probably the second most exciting country outside South Africa. Harare was our head office. So we actually listed the group in the early 1990s in Harare, in Zimbabwe. And actually through that listing, the family finally actually exited Africa. So having been in Africa since the 1930s, through a listing, we actually exited our capital and moved to London and ended up running a sort of quite diversified hedge fund and real estate business for about 25 years in London, where it's actually I spent most of my career. We then sold that business in 2008 for pretty obvious reasons. Hedge funds imploded. And I started reinvesting some of the family capital back into Africa, much to my father and mother's horror. We spent their lives trying to get out of Africa. I really saw the opportunity. Africa was a very different place in the 2000s than it was in the 1990s. And I really wanted to put a bit of capital back into Africa, both to achieve financial return and have a positive social and environmental impact. And that was 2012. I teamed up with another chap called Hector Fleming. His father, Adam Fleming, was part of the Fleming Merchant Bank. He went out to Africa in the early 90s to set up the Fleming arm of the Fleming Merchant Bank called Fleming Martin. So Adam had been investing and managing businesses in Africa since the 90s. So we formed this very small, informal 2-family partnership, being my dad and myself, and Adam and Hector, with a real vision to just source investment opportunities in East and Central Africa, where we knew well, not to have a fund, but to source deals to back African entrepreneurs to really build and grow their businesses and have a positive impact. So really Hector and I literally working from London, just the two of us in a mate's office, traveling out to Africa, sourcing deals and raising money through SPVs in Mauritius from our 2 families to back entrepreneurs. And that's how we started. We formed a 2-family partnership called Fleming Wulfsohn Africa. And it was just Hector and I at first. And then gradually brought in other families that wanted to join us. And we do these SPVs, raise money from a few families to back some more entrepreneurs. And we did that from 2013 to 2017. And then, we were just, to be honest, under-resourced, wanted to build up our vision. IMARA, a very old, established African asset management business, was listed on the Botswana Stock Exchange, and the Flemings and the Wulfsohns and a few other families made an offer to that stock exchange, and we took the business private at the end of 2017. So IMARA went from a public investment banking group to what we now say it is now a African specialist merchant banking group owned by a number of families, 2 on the US West Coast, 2 East US West Coast, a few UK, a few in South Africa, and the Flemings and Wulfsohns are the 2 biggest shareholders. Hector and I are the co-CEOs. All the families have deep knowledge and experience of both Africa and financial services, so they provide a very long-term, stable, supportive shareholders. And the vision is, as always, our vision is to raise private capital, not institutional capital, private capital, to invest in African businesses to really build and support domestic entrepreneurs and to achieve strong returns for ourselves and have a positive impact. And that has been our journey since 2013, and we are still committed to it. Can't pretend it's been easy. As I'm sure as everyone else will say, it's been a very, very up and down ride, but we are still here. And we're still absolutely committed to our vision and our story. And I'm very pleased to have this opportunity to share with people. How we see the continent, it's a very misunderstood place. I'm not saying we see it right, but I think we see it different to other people. And I think there clearly are opportunities in Africa to make strong returns, have a good impact with much less risk than people realize. Clearly are big risks. It is a frontier market. I don't want to pretend they aren't risks, but I think you can achieve returns with much less risk than people realize. And we have,
That's
actually,
right.
to be honest.
This is thank you very much. You've taken us through the whole journey up to now. But if we can rewind a little bit, so then you made your father decide to go back to Africa. You've convinced him to go back to Africa. Was it you who influenced that decision to move there?
No, he hasn't moved here. He stayed here. He's not involved at all. Hector and I are the ones that are running this business. Hector and I are the ones that went back to Africa. My dad spent his entire life trying to get out of Africa, not in a bad way. He lived there his entire life, and he had a very, very good life there and had a very successful business life there. But him and my mother were living in London. He was at a stage in his life when he was not going to go back to Africa. We'd sold our hedge fund business, and he was not looking to start something new. I was much younger. I was in my, I guess, late 30s, early 40s. I'd worked in this hedge fund world for 20 years, and I wanted to do something different. So really, I went out. I literally got on an airplane by myself, went to Zambia, Zim, Botswana, and South Africa looking for deals. I did that a few times, actually did find a great deal. And it was through that deal that I met Adam and Hector, and the Flemings and the Wulfsohns went into that deal. That's our first deal. And it has continued to be an exceptional deal.
Very good. Very
So
good.
that's good.
What is IMARA again, and what problem are you solving in the market? And then also the name IMARA, what does that name mean?
Yeah, so the name, we acquired the business, so it wasn't the name that we chose. It is a name, unfortunately, that has many meanings in many languages. So, it's a Swahili name, it's a Zulu name. It has lots of meanings, but in our context, it means beetle. And, it's a strong, robust animal that can survive in Africa. That's really building the vision of Africa. There are many, many other Imaras all over Africa that do very different things. But Imara really is now, as I said, a privately owned specialist merchant bank. Our vision is to attract private capital to back African entrepreneurs. We have a much broader range of offerings to achieve that goal, and we invest in both public companies, private companies, and venture deals. We also have an advisory team, a very, very experienced corporate finance advisory team. We also own a trust and company administration business in Mauritius. So a lot of the capital that flows into Africa flows through Mauritius. Clearly, all the companies we set up, we do with our own trust company, but that now has 300, the trust company now administers 350 companies and funds that all are investing into the continent. And then separately, we have some domestic stockbroking advisory businesses in Malawi, Botswana, Zambia, Zim. Yeah, Malawi, Botswana, Zambia, and Zim. We are part owners of some domestic stockbroking advisory businesses that are just domestic businesses. But the key vision for IMARA is to attract US dollars into Africa to back African entrepreneurs. And interestingly, we have most of our investments are done on a deal by deal basis. So I think there are two things distinguish IMARA from most other people investing into Africa. Actually, three things. Three key things distinguish us. Firstly, we are quite a diversified merchant banking group. So as you know, some areas do well at some times, some areas don't do well at other times. So we are able to support businesses that are, some of our divisions are loss-making and other businesses are highly profitable. And that changes around through the cycle. So having a diversified merchant banking group enables us to support for the long-term areas that are having a difficult time because of the profits of those that are doing well. And then from the investment perspective, we invest in the public markets through a fund. And on the private and venture side, we do it deal by deal. We don't think that the venture capital private investment strategy works on a PE fund, venture capital fund strategy. I don't want to criticize everyone else that's doing that. That's absolutely a clever way to do it. I'm not criticizing, but for us as families, we are driven by US dollar returns. We aren't driven by AUM or, on our private equity and venture side, we don't really charge fees. We charge an upfront fee just to do the setup. We charge no management fees or fees on the way. But when the investors make a 2 or 3x return, we will then start charging a carry. So we're really focused on generating US dollars back into our investors' bank accounts. We don't care about AUM or annual NAVs or annual performance fees. We really invest as partners, both for our investors and our founders, to really build the business together with an aim to generate US dollars back in our bank account because that is what we all need. We don't need AUM or performance fees. We need dollars back in our bank account to pay our kids' school fees. So we typically do one deal a year. And we're not a fund with X million to invest over a year. We spend a long time sourcing our deals, working with our founders, building those relationships. And over 2 or 3 years, once we and the founders feel comfortable, we will invest as very long-term partners. Because we don't have a fund has a life, clearly. A fund has an 8-year life, 10-year life. So there's an expectation across the board that there will be a liquidity event within the time frame of the fund. Because we're investing deal by deal, there's no expectation. So we all want a liquidity event, obviously, but the timing of that liquidity event is not driven by the terms of the fund. It's driven by what is best for the investors and the investees. There's no pressure to create liquidity within, let's say, 10 years, maybe 5 years, it may be 10 years. And most interesting, it may never liquidate. Our best deal is generating so much money in cash dividends, we're not going to sell it. We clearly could. We've owned it now for over 10 years. It's paying out a 50% dividend yield. We've had a 10x return, paying out a 50% dividend yield. So we've got no intention of selling it. It's not a fund, we don't have to sell it.
When we had our first conversation, you mentioned to me the number of applications that come through IMARA. But let's break down that journey. Imagine a founder is going to approach IMARA. How would that from start to finish take? And then you mentioned relationships. How are those relationships being built and established throughout? And then also, if you could take us through the you building together, and it takes, you mentioned it, 2 to 3 years to make that relationship stronger before getting into the business. So how does that take place?
Yes, I mean, Ala, we aren't the best source of capital for a founder, if I'm very honest, simply because we don't have a fund or a balance sheet, so we don't have capital easy to deploy. The capital we have comes from our families. IMARA is owned by 12 families, the Wulfsohns and Flemings and a bunch of other families. And over the years, we've obviously built a growing network of other like-minded families. So if a founder comes to us and says he needs capital, we don't have that capital. I've got to go out there and raise that capital from our families. Secondly, because we're not a fund adopts a portfolio approach. So let's say a fund raises 100 million. It's going to do 10 deals over 10 years. And between that time frame and the portfolio approach, a few of those deals will do well, a few won't. But overall, given the sort of the science of portfolio management, they would hope overall that fund would do well. On a deal by deal approach, you have a deal. There's no portfolio. That deal has to work. Otherwise, it doesn't work. So we are very focused on generating returns for a deal, much more than doing another deal. So our priority is to source a good deal, raise the capital, and build value together with the founders for that deal. And if that deal's not working, we won't do another deal. So the first deal we did back in 2013, we raised $5 million from the Flemings and Wulfsohns and a few other families to back a specific entrepreneur in South Africa. Within 6 months, he'd spent that $5 million and the business was bust. That was my first deal in Africa. And so
that was the first deal when you went back from
my first deal out to Africa. Yep, I found a great deal. The spreadsheets look great. The models look great. The business plan looked outstanding. We raised the 5 million, my money, Fleming money, a few other families. This is going to be our great deal. 5 months, literally bust. Money gone. So we
what was Wulfsohn?
I don't really want to get into too much details, but in case people on the call know
as an industry. Okay.
We were processing mining waste. And so the vision was we weren't miners, but there's a lot of mining waste, especially in South Africa. And so we are processing and cleaning that mining waste. And what you do is you process the waste, whether it's platinum, chrome, gold, you process the waste and produce the ore, and then you use the waste to fill up the holes. So we're kind of clearing up these massive mine dumps all around Johannesburg. But sadly, we're backing the wrong team. The business got too big. They couldn't handle it, and they spent the money and went bust. So as shareholders, there were 5 families. We had an SPV in Mauritius that owned the company, and we had 2 choices. Okay, guys, we spent 5 million. That's a lesson to learn. Let's move on to the next. Or let's get stuck into this business and solve the problem. And so for the next 3 years, we didn't do another new deal. We solved the problem. We found a new team, a really incredible, exceptional team. They're still running the business now. We raised another 5 million from ourselves to back this new team. And we had a very hairy three years of literally living on air, barely being able to pay salaries, barely being able to keep the business alive. And 3 or 4 years later, the team had turned it around, and we have now put in about £25 million of investment. We have had about 5x return on that deal in capital. It is paying about a 50% dollar yield every year. But I can't lie, the first 4 or 5 years are one of the most stressful times of my life. So my point is, because it's deal by deal, it's not, if that was in a portfolio, you'd probably think, we'll leave this one and do another one. This was our deal. This was my first deal. This deal had to work, as I was going to be working back in the hedge fund world. Hector and I really put our heart and soul into this business for 3 years and made it work. Found a new team, found some more capital, out there every month working with the new management team and really turning the business around. So we didn't do a new deal. So my first deal took me 4 years, basically.
But it paid back. But then how did that conversation take place when you decided to take that risk, same risk again? How were the 5 shareholder in the room when that decision was made? How did everybody react?
There's one thing always: people. We had found, to be fair, Adam Fleming found an exceptionally new team. This chap, the MD, is outstanding, and we believed in the new team, and the new team convinced us, because the business model was sound. It's just the first team weren't capable of actually executing it. It was too big a business for them. They were running a small business. We scaled it up massively. The business model was the right model. It's just the execution was shocking. And this new team are very experienced, and are exceptional. And between them and us, and we built a very strong family ownership structure where the management team had shares, we had shares. We really turned it around and built the business together. But it was down to one thing, as always: quality of people, trust, families, partnerships, long-term investing. We weren't a fund. There's no exit pressure. Has built this thing together. So just picking up the question you asked me right at the beginning, Ali, how do founders get into our radar screen? And this is unfortunately a difficult answer, because we do see a lot of deals, obviously. In fact, not by design, but just by mentality. Every deal we've done has been with someone we know. We've either known them from their previous careers. Some deals actually an ex-girlfriend. They've been in previous businesses, and we've only ever done deals with people we know. We never ever do startups. I just don't think there's enough risk in Africa without a startup risk.
That's
But
right.
we're very, very happy, and we really do like meeting startups. And we work with many startups informally, just to help them out. The rising tide of Africa, anyone we can help, we'd love to help. If they need capital, they need customers, they need introductions, we're always happy to help. And we build those relationships over 2 or 3 or 4 years with those founders, see those businesses grow. And as they get somewhere near, we like to invest somewhere near or post break even. But we're very, very happy to work with founders. We obviously know a lot of people in the space, and we're very happy to make introductions and connections and support that process. Our team is extremely experienced. We've all been doing this for 20, 30 years. We know the market very well. And the much we can, we like to build those relationships. And one or two of them will evolve into an investment. One or two may just become customers of another deal, or we just build that network. The rising tide of Africa, as we all know.
Yeah. And then during those deals and this initial stages, and you're looking at the business, and you obviously know the individual who we are investing with. What signals make you lean in, and what red flags make you pause through that process?
So, Ali, we are both, having been investing in Africa for a long time, as I'm sure you have and a lot of your listeners have. Africa is a frontier market, though it's obviously the size of Asia and has whatever couple of billion people in it, and a lot of land, a lot of mines. These are generally small countries. Nigeria being an exception, or maybe South Africa being an exception. Zambia's got 20 million people. Even Kenya's got 60 million people. These aren't big countries and not big economies. Although they have got bigger and a lot better. Egypt hit its biggest ever reserves of all time. They now got $50 billion of reserves. 120 million people. It's becoming a real country. But nonetheless, these are frontier market countries where macro events can throw these countries off course. Whether it's international or domestic, whether it's corrupt or incompetent politicians, the influence of China, influence of the US, influence of all these horrific wars going on, the Arab Spring, a whole bunch of domestic idiotic decisions being made by people all over the place. These events can really throw off the economies. So what we really look for, most importantly before the founders, we look for themes or sectors that do well despite the macro. There is a rising tide in Africa. Africa is going in the right direction. What themes do well despite the macro? What's going to happen despite the politicians, despite China, despite the wars? That's the key thing we focus on first. The obvious example is going back to the early 2000s. There was 1% landline penetration, 0 mobile penetration. Everyone said Africans can't afford mobile phones. Roll forward 8 years, there's 80% mobile phone penetration, despite 9/11, 2008, the Arab Spring, a bunch of other stuff that happened. Despite the macro, Africa went from no landlines to cell phone penetration, despite the macro. So, we really look first for, I think, the domestic consumption is the theme that's happening despite the macro. Mining, farming, safari lodges, energy, these are big projects. Africa's got lots of land, it's got lots of mines, but these things aren't really an African story. If you're building a mine, you've got to sell your stuff into the international markets. If you've got a safari lodge, it's international customers. So we really try and back domestic themes that happen despite the macro. What's really why I think people misunderstand Africa. Africa is not a middle class story. The perception is Africa has a middle class. It actually doesn't. I mean, there are obviously pockets of middle class. Africa's much early in its evolution. Africa's got a very fat wealth pyramid, a very, very fat wealth pyramid. Top 5%, political elite, expats, middle class. The rest of Africans live and consume at the bottom of the pyramid. They get paid daily, they get paid weekly, and they do their consumption in the markets. They don't buy stuff in the shops. They buy daily in the markets. So we really back businesses and themes that are enabling the African consumer to move from the informal to the formal. Economic formalization is our theme. How do you get someone to stop making beer at home and buy beer in shops? Stop milking your own cow and buy milk in the shops. Stop using cash and start using your mobile phone. So that is the key theme, backing the economic formalization across Africa. The classic story of the average age in Africa is 20, the average age in Europe is 40. Africa's got a very large number of highly educated, urbanized youth, all with mobile phones, keen to consume. Families are generally left on the farms. The kids are now living in the cities, earning money, got phones, want to consume. And they don't want to consume in the market. So that is the theme. And then beyond that, the founders and the businesses, it just takes time. Mm-hmm. Something's changed on my screen. Can you see me?
Yeah.
I can't see you anymore. Probably a good thing. Can't see me.
Maybe you pulled me down, or just try and check the browser.
It's saying uploading. Hold on.
It's the video, while it's recording, it uploads automatically. So you can see uploading on the top, but you should be able to see both of us on the screen.
Oh, there we are. There we are. Got it. Yeah, got it.
Okay,
I'm back.
right.
I'm back, Ali. I'm back. From a business perspective, again, this is probably not what founders want to hear. We don't back startups. To be honest, having been in business for 40 years, embarrassingly, a 25-year-old kid in Nairobi that's got some great new tech idea, it's just a big risk. We like to back guys that have done it before. First, we back old technology. We back fintech and payments, but not modern tech. In the developed markets, when you say fintech, it's AI. In Africa, when you say fintech, it's mobile payments. This is old tech. It's not new tech. It's not something revolutionary. It is old tech in new markets. You like backing old tech, basically payments, in new markets with businesses that are run by people that have done it before.
And other people may not agree with you. They might say, we backing tech that is using the latest technologies. Why would you choose that approach?
Honestly, Ali, it's my money. I want to try and make money in the least risk way. Absolutely not saying I don't want to criticize or downside. These guys are great. I go to Nairobi a lot, or Cairo a lot, or Joburg a lot. And I spend a lot of time meeting 20-year-olds, 30-year-olds with some brilliant ideas. Absolutely 100% support what they're doing. It's brilliant. I'd love to help them in any way I possibly can, where we can make introductions to investors, to customers, to backers. More, I really would love to hear from them and see what they're doing. Ali, I'm an old school, I don't know what AI is, let alone in Africa. Payments is happening. The shift from cash to non-cash is happening. The consumer, what's interesting about cash to non-cash, Africa needs to digitize. Africa needs to go cashless. The rest of the world has gone cashless. I know you live in London, don't you? I've forgotten.
In the UK, in Belfast, yeah.
Yeah. You live at Belfast. I live in London. I mean, I haven't had a note in my pocket 5 years. Africa needs to go cashless for all the reasons we know. And what is bizarre is that the consumer, you and I, actually, this is globally, you and I and the African consumer, we've all been very well serviced to enable us to consume without using cash. We have physical cards, we've got virtual cards, and then on our phones, you've got a multiple of apps, Apple Pay, Google Pay, Venmo, Revolut, everything else. There are many ways that you and I can transact without using cash. The bizarre thing is, and this is globally, not just in Africa, when you go to a shop to get out your cashless app, the only way that shop can accept payment is either cash or this thing called a hard point of sale device. This old, clunky bit of kit. Every shop, restaurant around the world can only accept payment cashless on their hard point of sale device. When you take your phone out, your card out in any shop in Belfast, you've got to tap your phone or your credit card onto a hard point of sale device. I know and the POS device, they're getting ever smarter and slicker and nicer and more functional, but nonetheless, that is a bit of hardware. Someone has to manufacture that point of sale device, pay for it, deliver it, and maintain it. It's hardware. It's like the landline. It's like a fax machine. This is hardware. Our life has gone software. Nothing else we have in our lives is hardware. Why is it the merchant? So bizarrely, the consumer globally has been very well serviced for cashless payments. But globally, the merchant hasn't. He still has to buy a hard point of sale device.
Mm-hmm.
Yeah, the world's missed a trick. So that is very dramatically changing in the first world. And you'll start seeing what's called a soft POS globally. This hard point of sale device. Do you have Itsu in Belfast? The shop Itsu, the restaurant Itsu? The Japanese restaurant Itsu.
Yes.
So you go to Itsu now. I'm sure when you go to Itsu, when you order your food, they've got this very smart new screens. There's no cash tills. It's a smart screen. You order your stuff all on the screen, pick your food, take away, eat in, and click your order. And then at the bottom of this very, very smart screen, they've shoved in a hard point of sale device. You can't tap your phone on the screen. You have to tap your phone on this point of sale device. So Itsu's had to buy this POS device and shove it into the bottom of the screen. Why can't you touch your phone on the screen? You can't yet. I don't know why you can't. You're about to be able to globally. So the hard POS is going like the fax machine globally. And there are many others. There's QR code solutions. But what is interesting in the African context, and specifically why we back this theme, is that in Africa, the hard point of sale device is not ubiquitous. In the West, everyone has a hard POS. Restaurants, shops, taxis, everyone has a hard POS. But in Africa, the banks did not roll out the hard POSs. They only did it to the big supermarkets. It wasn't worth them driving into rural Nigeria, rural Kenya to deliver a POS to some farming guy in the middle of nowhere. It's just not worth the effort. So the rural, other than the big shops, most of Africa's merchants don't have a point of sale device. So you as a consumer still have to go to the ATM device, ATM, get cash out to buy your goods in the market. The consumer wants to go cashless, but the merchant can't because he's got no POS. He hasn't got a POS. So the banks are now rolling out soft POS across Africa. They are rolling out because it doesn't require any technology. If you are a merchant in rural Nigeria and you're an ABSA client, when you now download the ABSA app, which provides all your banking services, on that ABSA app is a point of sale device. So suddenly this merchant has got software that enables him to accept payments without cash. It's not hardware, it is software. There's no cost. This doesn't require him to pay anything to get that soft POS. So what's amazing is the marginal cost to add a new product and a new customer is zero. To add a new hard POS customer, for a bank to add a new hard POS customer, they're going to buy the POS, they're going to drive the POS out to the shop, you're going to plug it in and you're going to maintain it. There's a lot of cost to deliver a hard POS. It's soft POS. There is zero marginal cost for the customer and the merchant. So the reason Africa has not gone cashless or digitized yet is because the merchant does not have a hard POS. Now they're rolling out soft POS. Africa can finally digitize and go soft to cashless. So we are backing businesses that deliver that soft POS solution to the merchants at zero marginal cost and enabling Africa to finally go cashless.
And then at some point in time, if we look at Eind Finance, for example, they're a great example of how they've used systems to understand the patterns and data to understand their users.
Yes.
And in fact, they look at it as with less friction when you are automating that process using data and algorithms, right? And then AI. So now we're here. And once those systems are integrated and we're moving to a software and non-cash processes across the region, we would need to implement also systems that can help us automate and understand the clients that we are, or our service users.
100%. 100%, but we're just a couple of steps behind.
Sure.
And I need fucking plugs don't work. So we are 1,000%, literally 1,000%, but we're not there yet. Africa needs to digitize the merchant. Let's get that stage done. Africa's still 80% cash, mainly because the merchants don't have soft POSs. Let's digitize Africa. And then we can start doing all these interesting data analytics, downloading AI and enabling all these other fintechs to get involved. It's very early in its development. Everyone in Africa has a mobile phone. Everyone has a bank account, but they don't have the ability yet to go cashless. You need to digitize the merchant. That's the last step in the process. And the business we are backing, one thing a hard POS delivers is confidence, security. When you go to a restaurant and you tap your phone on that hard POS device, you have absolute confidence that money is going to the restaurant. Move forward to the soft POS world. If you're in a big restaurant, they bring the bill. Right now, you got to wait for the hard POS to come around. But in the soft POS world, you don't need to wait. The waiter brings out his phone. No waiting for the hard POS. He brings out his phone. You tap your phone on his phone. How do you know that money's going to the restaurant, not to him? So MasterCard and Visa are driving this whole soft POS theme. You need to be MasterCard and Visa certified to enable that soft POS technology to be rolled out by the banks. So it's actually the banks and Visa and MasterCard that are driving this. And the business that we are backing has Visa MasterCard certification for Africa, and Visa MasterCard are driving their solution to the banks and the telcos. So Safaricom, MTN, Absa, Standard Bank are all using this company's soft POS solution because MasterCard and Visa card are telling them they all want soft POS.
Okay.
So you're right. Africa's always 10 years behind. Let's digitize Africa. Let's make it cashless. Let's get everyone into let's financially include everyone. This brings everyone into the financial inclusion. It has government backing, regulatory backing. Everyone wants it. The customer wants it, the merchant wants it, the bank wants it, Visa wants it. And once we digitize everyone, we can then start selling them other stuff. You can start doing. So that's the thing about Africa is these businesses have very long and wide runways for growth. In the developed markets, let's take UK. If you're a telco like Vodafone, you have 5 or 6 competitors. So you've got a very short length of run.
Gradual move into non-cash initially, digitizing the process, and then we'll think about analytics, data, predictions.
Exactly. Once you got them, once Africa is digitized and financially included, you can do all that. And you take a business like MTN, which is obviously Africa's largest telco, compared to a telco in the West. Vodafone UK has got 5 or 6 competitors. All they do is voice and data. They can't widen their runway. If they go into any of these analytics or financial services, there's huge competition. Whereas Vodafone Kenya, being Safaricom, is only half voice and data. Other half, obviously, is M-Pesa. And they can add on ever more services. So data analytics, financial services, lending, credit, paying your bills. And they go into other services, there's no competition. So these businesses in Africa have very long runways for growth because most people are still not using mobile payments, still using cash. And very wide runways for growth because when they diversify into other areas, there's no competition. Vodafone Kenya is so different, as such a different business to Vodafone UK because one, they've got this very long runway of growth as they expand voice and data into Ethiopia, into DRC. And a very wide runway for growth is they can add on ever more services at no marginal cost. If you have a Safaricom account, all Safaricom has to do is download an M-Pesa account, a pay your bill account, any other service. It doesn't cost Vodafone anything to sell that product to you. They just download it. So there's no marginal cost to get a new customer. So that's why the businesses that we invest in are B2B. I do see, if you want to ask about founders, what I think founders' big mistake is, not big mistake, I don't want to sound like I know more than them, which I don't, and I think they're doing an amazing job. I don't want to criticize, but most fintech decks I see, the second slide is we're targeting the billion unbanked. There are probably a billion unbanked in Africa, but as you and I know, they're very, very hard to access. and find and service. But the banks and telcos, Equity Bank, Safaricom, MTN, Fowry, these businesses have the customers. So we back fintech businesses that deliver B2B solutions to the banks and the telcos to enable them to deliver better services to their customers. The business we're currently investing in is rolling out soft POS solutions to the banks and telcos. Their customer is Absa, Standard Bank, Safaricom, KBC, bizarrely JazzCash in Pakistan, because they have the customers. So we really believe the way to invest in this whole payment theme is to back fintech companies that are delivering solutions to the banks and telcos to enable an ever wider solution or services to their customers because they have the customers. And that's kind of our vision. So as a founder, these deals look great. The businesses look great. We are a couple of families doing a couple of deals a year. Please don't take me as a benchmark or weather marker what's happening in Africa. Also, a huge number of amazing people doing amazing things and building amazing businesses across amazing sectors. And I absolutely support them. And if they want help in any way I can, I would obviously love to. We invest in B2B payment companies. That's our investment thesis. But where we can help in any way at all, please honestly give me a call.
And what is beyond fintech, and financial services, Harry? Which sectors are most investable, near term? And what gives them leverage in Africa today?
In my honest answer is the payment fintech theme has got such a long way to go. It's just starting. We're 80% cash. We really believe in the mobile phone. What Africa has is a very young, educated, urbanized youth that has a mobile phone that wants to consume. We personally don't really believe in the farming, agricultural, energy sector. Obviously that's massive and huge, and Africa has a huge amount to offer the planet in terms of energy and green solutions and agricultural products and lots of new innovations in those areas. It's just not we have become very payment focused. We invest in public, private, and venture companies and advise in those companies because we just see such a long and wide runway. And to be honest, having done this for literally 30 years, we've made investments all over the place. The challenge is the smaller economies are small, really small. So we really focus on the bigger economies, Morocco, Egypt, Nigeria, Kenya, and South Africa. Obviously, in Nairobi, a business based in Nairobi services the whole of East Africa. Equity Bank's the biggest bank in East Africa. Safaricom's the biggest telco in East Africa. So we really focus on those 5 countries. They're just the biggest, most dynamic growing countries. I'm from Zambia. I believe in Zambia. We do have investments in Zambia. We do have investments in Malawi, Zambia, Zim, and Botswana, because that's where I come from. That's where we know. But if I was a new investor into Africa, I'd focus on the bigger economies and the themes that happen despite the macro. Backing a mine, you're dependent on global prices of your product or the walls. There's so many other problems. We as a family own cattle farms for 40 years. We had 40,000 head of cattle in Zambia. If I can not sound too crude, we were from semen to burger. It's a fully integrated cattle business, and a lot can go wrong between the semen and the burger. That is out of your control, really. And so these payment businesses, there's very low capital expenditure. You're backing a theme that happens anyway. Really bright, experienced people are running these businesses. And it's old tech in new markets. This is not new tech in new markets. This is old, well-proven, well-tested tech, as we all know, in new markets. And people are desperate for it.
I just need implementation. Yeah, you're right. Absolutely right.
And the one thing that I love to do, and it's very hard to do, and it's very frustrating, anyone who wants to come on a trip with me to Cairo or Nairobi or Joburg, please come with me. Come and meet these businesses. Come and see what happens on the ground. See how M-Pesa works. See how these mobile pay. Well, M-Pesa makes Apple Pay and Google Pay look like dinosaurs. M-Pesa, the way M-Pesa works and what it can deliver as one of many examples. Or go to Fowry in Egypt. What Fowry delivers to the Egyptian consumer is exceptional. They actually they're delivering a better product, a better solution on the phone to a very underserved consumer.
And then when we had our first conversation, I really enjoyed your perspective into Africa, and we thought maybe we can discuss it here so listeners can really understand more about Africa. But before we get into that, in terms of fintech, just a quick comparison, Africa and the global fintech industry. What patterns are there? Yes, it's everything. We're not there yet as a continent, but then let's just bring that, as a vision to the listeners.
So, Ali, I think the word fintech much like the word, I was in hedge funds for 20 years. The word hedge fund got very abused and misrepresented. The word fintech means very different things in very different places. So actually in Africa, it's not really fintech. It is payments. This is a payment themed transitioning cash to non-cash. If you're in LA or San Francisco, you say fintech, they mean something I don't even understand. AI and all the stuff that I just do not, and my kids are living in that world. I do not understand it. Africa, but there are businesses, yet again, there are businesses in Nigeria and Kenya and in Cairo that are run by really bright, ex-Harvard educated Africans that have gone home and developing amazing fintech solutions. Without a doubt, there's some whole load of stuff going on that is just not my space that I understand. What's great is people are going back to Africa to really take advantage of this educated youth there's a very underserved educated youth. Pre-Instagram, pre-TikTok, they had no reference to the West. I had lots of friends in Zim growing up, and their point of reference was Zim fashion. But now their point of reference is Instagram fashion. They want to dress like the West, obviously. They want to dress. Why can't a 24-year-old in Joburg wants the life that a 24-year-old has in London and New York because they see it on Instagram? And why shouldn't they? So they are now holding their leaders to account to say, I want you to deliver to us the life that we could be living in London or New York. Why are you not delivering the services and the quality of life, education, housing, healthcare, fashion, technology that I can see that my counterpart in London and New York is getting on Instagram? So it's all about, there's a massive underserved consumer, and there are people much brighter than me that are delivering technology through the phone. The big game changer is obviously the phone, that are doing that. And I would love to help and support them. It's just an area I'm just not that experienced in.
Not yet.
But I really, 1,000% support. I meet them many times all over the place, and we are fully 100% supportive in any way we can, and encourage and love what's happening. Fashion, music, technology, it's just great, obviously.
And, we both in the UK right now, right? We know how people present, or some people may have, or what their perspective on Africa, right? Not just in investment and not just in businesses, but you mentioned in the initial conversation we had that there is a big potential in Africa. So what would you say to those people that don't really understand Africa? What is in Africa, not just in terms of investment, but in terms of potential for 10 years from now?
So, Alan, just to correct you slightly, I didn't say there's a big potential in Africa. Africa is obviously the size of Asia, and it's 55 countries. I don't think there's a big opportunity in Africa. Africa is a huge place with very, very different dynamics across different countries, all pulling and pushing in different ways. I think it's a very misunderstood place, because people think it's a country, not a continent. Each country is extraordinarily, Kenya is, obviously Kenya and Somalia, you can't compare for multiple obvious reasons. I think, all I can say is what we do. We are a few families. We invest in 4 or 5 countries. And in those countries, you invest in 4 or 5 companies, sometimes public, sometimes private. We're very, very focused on what we do, as you would do here. If you were a family like us in the UK, you're not going to invest all over Europe. You're going to pick your theme, pick your deals, and do a very focused, close, understood, bottom-up, detailed portfolio. You can't compare Mozambique to, obviously Zim is Zim. So all I'm saying is Africa has, there are parts of Africa that have huge potential that I think is now finally demonstrating itself as real. People have never really believed in the potential in Africa because there have been many false starts. I am very confident and have high conviction in the fact that we are now seeing, honestly, a true shift in the dynamics in certain countries and certain themes in Africa. And I believe if you are a global investor and you want to look for the next opportunity, I think there are some really, firstly, pick some great countries, but in those countries, some really great companies run by really, really educated, aligned, committed entrepreneurs, often highly educated, that really believe in delivering services and solutions to the underserved in these countries to both make strong returns and deliver positive social impact. But that is not Africa. That is certain countries, certain businesses, and certain sectors that I think is how to do it. I mean, separately, IMARA has uniquely a public market business. It's not something that me and Hector set up 20 years ago. IMARA had a fund that invested in African public markets, listed shares. And that's an interesting, if you look at the history of this public market fund, it's been pretty up and down. Public markets do reflect global views of a country because public market valuations are driven by liquidity. Shares on a stock exchange value depends on liquidity on that stock exchange. This does not generally depend on the fundamentals of the company. So business like Safaricom or Equity Bank or Fowry, these are quality, or MTN, these are quality businesses growing at 50, 100% year on year. They make billion-dollar profits. Equity Bank pays a 12% dividend yield. They're growing, profitable, listed, well-run, well-governed businesses that have been doing this for 10 years. They've been grinding out these numbers for 10 years, but the valuation has not reflected the fundamentals because there's no liquidity. So what has really changed this year is that liquidity is now coming back to these markets, which is a demonstration of global views of Africa. So you can take that as a kind of, whether you do VC or PE, the fact that the liquid markets are now flying, they're up 50, 100% over the last 12 months, is a reflection that international investors now have confidence in these markets. And the big difference this time to last time is that, no offense to foreign investors are quite fickle. They come and go. They come in, they follow the cycles. They come in near the bottom, they go out near the top. And that creates the volatility. The big difference is that in these big African countries like Kenya, like Cairo, like Egypt, like Nigeria, politics is improving. Central banks is improving. Regulations is improving. And it's driving a domestic pension fund and asset management community. And a large part of this current rally is not international investors. It's also domestic investors. It's domestic pension funds. The Nigerian pension fund has gone from $1 billion to 40 billion over the last 5 years. That money does mostly buy T-bills, but some of it goes into the markets. So a large part of this rally is both foreign investors, that gives us confidence, but also this new big pool of domestic capital that's investing in these domestic shares. And domestic investors are clearly long-term, supportive, and not fickle. So we really have confidence in this rally. We're up 50% year to date. The markets are up 50% year to date. The rally's just started. People are concerned. They think they've missed the bounce. We've missed the bottom. Any investor knows you do never, ever invest at the bottom because you never know when the bottom is. The time to invest is a few months after the bottom. We've had a 6-month really strong rally, both from foreign investors and domestic investors across the African markets that are really driving an exceptional rally. Everyone's up 50, 60%. And we've just started. These are from insanely low valuations. There's small money coming in driving this rally. And we really think we're at the beginning of a very strong and sustained public market rally, especially in the payment, fintech, and consumer sectors across the continent. And we haven't seen this for 4 or 5 years.
So, and then in comparison to, in terms of potential on investment, looking at it back then when, in the 2000s, and now, where do you see is the best time? Are you saying the best time's now?
I'm not a market timer, and I'm not an economist. I don't like to this is not a quote. This is very much a personal view. I don't want to sort of pretend I really understand markets like these fund managers. But yes, I think this time is very different to previous times. Africa's, we've been there since the 1930s. And there are times when we were doing very well, times when it was horrific. And obviously Zim has gone through a huge cycle of being the best market to the worst market. But I do think there is a rising tide in Africa. Things have changed very materially the last 5 years because the youth is now educated, out of school, living in the cities, getting jobs. They've left their families are typically, and that's a very general comment, but families are typically still on the farms. But the 20-year-olds have moved to the cities. They're getting jobs. They have mobile phones, and they're holding their leaders to account. They don't want post-colonial rhetoric. They want housing, education, jobs, decent roads, keep inflation down, cut interest rates, I want to improve the ability to bring in services. And they're demanding, as you and I do demand from our leaders, decent quality of life. Mm-hmm. So I do think there's a big drive from the urbanized youth. I do think generally the politics have improved massively. I mean, there's still endless stupid decisions made by these political leaders. Again, please don't quote me on that, but they are still massive improvements by the political leaders, by the central banks. Currency management's much better. Egypt's reserves are now at 50 billion. It's an all-time high ever. Nigerian's reserves are back to 2018 levels. The World Bank has now upgraded sub-Saharan African forecasts. The Frontier Market Index is now adding Nigeria. There's lots of things that are really driving global interest and support and belief in these countries. It's becoming, and the press is much more positive. So there's definitely a rising tide in Africa. And then combined with that, backing a theme that we believe in, being this payment theme, is going to happen. The rising tide supports it. The theme happens anyway. A weak dollar supports it. Weakening dollars support emerging markets and frontier markets. There are lots of things that are happening. Weaker dollar, better politics, better economics, the mobile phone.
Better exposure as well, in general.
Yeah, it's a general exposure. You just read the FT. There's definitely becoming a more, hopefully, a mainstream opportunity. And the time to, and I hate to say this as I'm selling Africa, the time to invest is not at the bottom, but near the bottom. These are small countries. These are big companies in Africa, but small companies globally. Kenya has one telco provider. One. London has 5. Safaricom has 80% market share in Kenya. Where do you find that in the world? That's extraordinary. Their 80% of telephone calls and mobile payments are done through Safaricom. In Egypt, Fowry has like a 60% market share. MTN has 280 telco customers. That is the size of the US population. These are just massive companies, and that's nothing. They've got such a long runway for growth. They haven't even started growing. And they've got Momo. MTN's got Momo and insurance products and payment products and FX products, widening and lengthening their runways with no competition. Nothing. It's extraordinary. At valuations, and because frontier markets have been off people's radars for the last 3 or 4 years, valuations are insane. So we've had a 6-month strong rally, but the valuations haven't even started. So take a bank like Equity Bank. Equity Bank, Africa's largest bank, East Africa's most successful bank. It's not really a bank. They don't have high street shops. Everything's done through the phone. They've got a thing called Equitel. Equity Bank has something like 20 million retail customers. So those customers are the ones that make the deposits. Banks need deposits. Their deposits come from 20 million customers. Hugely diversified customer base. They all have call accounts, so they don't really earn interest on those call accounts. And Equity Bank takes that money and buys Kenyan T-bills at 9%. So it's not a bank. They take deposits at 0 interest rates, and they buy Kenyan T-bills at 8-9%. So their NIM, the net interest margin, is about 8%. They have no credit risk. And then the biggest bank in East Africa, and they don't have any high street branches or all the high street costs that we have in the UK. Everything's done through their phone, through Equitel, but their valuation is 2 times earnings. They're valued at 0.7 times book. That means their book's about to go bust. If you value a bank's book below 1, that means you think their book is going to go bust. But their book is 20 million depositors and Kenyan T-bills. And they have a 25% capital adequacy ratio. The EU requirements are 10%. So it's just a well-run, well-governed, low-risk bank, growing at 40% ROEs, made $500 million of profits last year. It's paying out a 12% dividend yield. 12% dividend yield. It's expanding into the DRC. I mean, it's just one of the most exciting growing businesses on the continent at a 2 PE, 0.7 time book. You're buying, and it's basically a mobile payment. It's not really a bank, it's a mobile payment. It's Revolut. It's Venmo. It's basically Venmo and Revolut for East Africa. Yeah. And I could keep going. You better stop me. You tell me when to stop.
This is really, really valuable discussion, honestly, for those who are investing, for those who are starting. You brought a lot of insight, Harry, today. My last question, one piece of advice you would offer to founders or operators listening to this conversation and looking to invest in Africa.
What, to investors or to founders?
Founders and operators right now in the continent, what would be your advice to them? Either they're looking to scale or they're looking to invest.
So for investors, everyone misunderstands the risk. There's one main risk in Africa that everyone misunderstands. As a dollar investor, the main risk is currency. Now, that is what you got on. It's not politics or wars or all this other rubbish or corruption. The risk to invest in the continent, if you are investing dollars into Naira or Kenyan shillings, the risk is understanding currency and making sure you manage that currency risk and really understanding how you're going to get your dollars back into your bank account. For founders, it's, personally, we go for what's been done before. I know these young guys have got great ideas. I just don't understand them. I think, there's so many examples of well-tried and tested business models, not just tech, multiple business models that are being well proven in developed markets. And Africa's got this vast underserved consumer. Service the bottom of you're going to service the whole wealth pyramid. Don't service the top 5% because they are tiny. You have to deliver products and services to the entire wealth pyramid at the right price point and convenience that enables a informal consumer to become formal. It's all about economic formalization and delivering consumption to the whole wealth pyramid that gets them out of the markets into the formal sector, whether it's through the phone, whether it's cash to non-cash, or just beer. I mean, beer is the classic example. Most Africans still make their beer at home, which is unhealthy and pretty much disgusting. If you can find a beer product, and there are many examples all over Africa of beer companies that are producing beer at the right price point and quality that gets the teenagers to go and buy the beer in the shops instead of making it at home. Because it tastes nicer, it's much healthier, and costs the same as making it at home. And I could go into a whole another beer story about the beer scenario, but beer is a great example. Kids don't want to make beer at home because it's unhealthy.
And there are other items as well, I would say. It's not just the beer. There are so many products in Africa that you could package well and then resell.
So another very quick example is milk. So when you and I go and buy milk, I don't know what you do when you get to the supermarket, you probably buy a 3-pint of milk that lasts the week. Yeah, you go to whatever, Tesco's and buy 3-pint bottles of milk. Typically, the Africans get paid weekly or daily. They can't buy a 3-pint bottle of milk. They generally go home and milk their cow. So you've got to sell milk in quarter pint, tetra pint. Quarter pint tetra boxes, not a 3-pint bottle, quarter pint tetra box, because that's what they can afford. That's what, in the emerging markets, frontier markets, people get paid daily, not monthly. So they will buy their milk daily. I mean, the other classic well-trodden story is the Nestle Maggi seasoning in Nigeria. If you know the story, I'm not sure I should say this publicly. I'm not sure I know the details properly, so please don't misquote me. I do apologize to Nestle if I'm misquoting the story. It's been a story I've heard a lot. But Nestle Nigeria, a huge, big consumer business in Nigeria, as big and as successful as Nigeria in Europe. I believe they had a European manager running Nestle Nigeria. And one of their products was Maggi seasoning. And they were selling Maggi seasoning in sort of 250-gram bags, and no one was buying it. And then they replaced the Nestle manager with a local Nigerian manager who just changed the Maggi seasoning, the same product, from 250-gram bags to 5-ounce cubes. And now it is ubiquitous across Nigeria. It's like Big Barrow here. Everyone Maggie's their food. And just to be clear, please, guys, I do apologize if I got that wrong. I don't want to be quoted and misquoted. It's a nice story. It's about understanding the domestic consumer, how they live their lives, how they get paid, how they consume, and delivering products and services that enables economic formalization out of the markets into the shops, quality, price, and convenience, and the phone, and delivering services to the underserved. There's a vast number of underserved consumers.
And you dropped a business idea right there before the Maggi, which is the milk. Somebody could take that away right now and work on it.
I promise you, man, it has been well. It is. I saw it. It's not my idea. I've seen it. So please, it's not my. I would hope someone does it as well.
Yeah,
I have seen it. I've seen it in Kenya. It's not my idea.
Harry, it's been a very insightful conversation.
Please.
Really enjoyed it very much. The first one and this one again. Thanks for going beyond the board with us. We will link IMARA in the resources mentioned in the show notes. And thank you very much for giving me your time today.
3 quick product sell. One is we have this fund that invests in African listed companies. It is honestly, it's up 50%. It hasn't even started. The rally's just beginning. The businesses are the biggest businesses in Africa. They're delivering payments and they've been growing, doubling in size for years. They're now finally going up in value, called the IMARA African Opportunities Fund. Separately, please go on to www.imara.com. We do a lot of research, and please do get in touch with me or my PMs, and we'd love to chat to you all. Ali, thank you very much. I had to plug my products, plug my story.
Thanks everyone for listening.
Thank you,
I'm
everyone,
Ala,
for
and I'll
listening.
see you next time.
Thank you all. Appreciate the time.